Good evening, good afternoon, and good morning, depending on where you are watching me from. This is some worldly ones here again. In our previous discussion, we learned, it's the second session, we learned how to understand charts, the type of charts, the daily, weekly, and other time frames. We learned who a scalper is, who a day trader, and who a swing trader is. Now, because we're able to learn how a candlestick is being formed or how to read charts, how are we going to know that this chart is going up, going down, or sideways? So today we are going to treat something which is called market trend, which will help us identify any chart on the market, or which will help us identify any chart, either is an uptrend, a downtrend, or consolidating. Then when we are done, we treat a couple of indicators which are generally or mostly used by traders to make analysis. So as we will start, the Forex market is either it moves up, it moves down, or it will move sideways like this. So once you find any chart, you should be able to know the chart is moving up, moving down, or moving sideways. If it's moving up, we call it bullish trend or bullish market. When it's coming down, we call it a bearish market. And if it's moving sideways, we call it consolidating market. So let me break it down. For a market to move up, the market does not just move straight up like this. It moves in waves. It goes up, comes down a little bit, goes up, comes down a little bit, as you see on every market chart, being indices, crypto, Forex, whatever. This is how it keeps on moving. Then, if you see like this is an uptrend. So I'll just place it here. Uptrend or bullish markets. So if it's a bullish market, we have two phases to identify the market, which we have the high. Sorry, let me turn on the cuffs. High. Then we have the higher low. Okay, so I'll just do a couple of these. Okay, just a minute here, right here. Once I'm done, I'll explain everything to you. So if the market is moving up like this, here it's called a higher high, then here it's called a higher low. Actually, it will make sense, but once we keep on going, you begin to understand me. This is a higher high because this is just a fraction of the chart. But if once we continue, you get it along. So now we have another higher high because this high is higher than this previous high. And we have a higher low because this low point of the market is higher than this low. As we have this higher high, because it is higher than this high, then this low is also higher than this low. That's why it's called a higher low. So it will keep on moving. But when we get to a place like this where the market comes equal, this place tends to be a higher high, whilst over here, this point of the market tends to be a high. This place of the market tends to be a high because this high is not higher than this high. And this, let's take it for instance, this place is also the same as this, or the same line as that. This will also be a low because this low is not lower than this low. These highs begin to become higher than the previous highs But once they are the same size, a high will be formed, then a low will also be formed. So if you look at any market and we find a higher highs, higher lows, higher highs, higher lows being formed, then it means we are in a bullish market. Now let's move to the bearish market. Sorry. So this one will be bearish market or downtrend. So as we learned, higher highs and higher lows is the uptrend of bullish market. The same thing implies here, but here is just an inverted side of it. So if you see the market, so as this one was higher highs and higher lows, here will be lower lows and higher lows. So so as we can see, this is a lower low being formed, and this is a higher low being formed. Then this is a lower low because this low is lower than the previous low formed on the market, and this point of the market is also higher than this low. So this is a higher low, meaning this low is lower than the previous low, and this one is also higher than this previous point formed. A lower low and a higher low, a lower low and a higher low. When you are in a bearish market, we form, so you should be able to identify the higher low point and the lower low point on the market. And once we come to a range where the price of the previous structure is the same, over here, it will just be a low. It will just be a low because this point of the market is not lower than the previous low. It's just equal. So here will also be a low. So it keeps on forming the higher lows and the lower lows. Then we call it the bearish market. Then we have the other market, which is sideways or bearish market. Most traders tend not to trade this type of market because it doesn't really follow any fixed pattern. So it's very difficult to trade. So most traders ignore whenever they see a consolidating or a sideways market being formed. Right now, we are done with this. Let's do a quick wrap up in the normal market analysis. So I will just choose any time frame and maybe a random. Let's use just this current one here. Actually, we can see now we are in a, actually over here is just a higher, so you can see this point of the market is a higher low, but this is a higher high because this high is higher than this previous one. So this one will be a higher low, as we learned earlier, a higher high and a higher low. This low is higher than this one, and this high also higher than this point. So this will be a higher low, a higher high, a higher low. Then since this one did not break this point, this one will just be a high. So that's how it is in the Forex market. And as we learned, the other one will also be, I just want to find a bearish market, then I will just use that one also to interpret the lower lows and lower highs. So let's take this point for instance. Once we use the daily time frame, we can just see over here. Let's use over here this one. Lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high. So you can just see this previous one is just higher than this low, a lower low, a lower high, lower low, as we learned earlier. And this can also be a perfect example for sideways markets. this one right here. As we can see, the market keeps, it broke this high, came just a low. You just keep moving in the range, not really clear. This is a daily candle. So once you zoom in into for a 1 hour probably or 30 minutes, you just see how deep consolidated it is. So we have a couple of indicators we just talk about. The mainly used indicator is the moving average and parabolic SAR. That's the two most indicators I was using initially, and even till date, I still use it along the way. So I will select the moving average. The moving average, as you can see here, we have the moving average, we have exponential moving average, weighted moving average, simple moving average as well. So you can see a faint line being drawn on the screen at the moment. So I'll just deepen it a little bit. I'll just deepen it a little bit. I'll just deepen it a little bit. As you can see, there is a faint line. So once there is a line like that, this one, you just have to calculate and work on it, which gives you the perfect number, as we'll be talking detailed later in this course. This is a 9 EMA, meaning exponential, this is EMA, meaning exponential moving average 9. So meaning it calculates the average exponential number of the previous 9 candles, irrespective of the time frame you choose. So this is the daily time frame. Once, let's say we choose 1 hour time frame like this, it will just calculate 1, 2, 3, 4, 5, 6, 7, the 9 previous candle, and it will help us indicate whether it's going down or going up. Some people use multiple of moving averages. Maybe they will have the 9 EMA, and then they can also have, let's say probably 20 EMA. This, for instance, they can have the 9 and the 20. So once it happened that way, you can see there has been a double line. So maybe they'll be like, once the one moving average crosses the over, like over here, they will just buy, wait till it crosses over, then they sell. I have a strategy for this. I'll later talk about it in the upcoming videos. Then we have another indicator mostly being used, which is called parabolic SAR. So you just select parabolic SAR. We have thousands and maybe hundreds of thousands indicators. You can see a dot, some dot has been added on the charts. So let me just deepen it so that it will help us see it clearly from my computer. All right. So you can see, so maybe you can just take, this is a 2-hour chart. So you can see maybe once the dot comes upwards, you can just sell till maybe there is, so over here, you can just get a perfect entry around here. Then you put your stop loss right above the structure. You'll be able to understand as time goes. You hold it till you find another dot over here, maybe behind, and that can be a perfect trade. So that will be it for today. Then in our previous, in our next discussion, we'll be learning real market structure, not the market. Now we know the market trend, so we'll get to know how the market structure also works, then how to use some fundamentals to help us when it's come to trading, either to be the spikes, the CPIs, and NFPs and others. So we will call it a day and probably meet you another time. Thank you, Samuel here. Have a great evening, a great morning, and a great afternoon wherever you are watching me from. Bye.